Ready to pick stocks like a Wall Street legend.
I'm game if you are. Who are we talking about?
This deep dive we're taking on the advice of Peter Lynch, the guy who ran Fidelity's Magellan Fund.
Oh, wow. Yeah, turned it into this massive success story. What's his secret sauce?
Well, that's the thing. He doesn't believe in fancy algorithms or insider secrets.
Really?
Nope. He actually thinks you have what it takes to invest wisely. You just need the right tools and approach.
I like the sound of that. Everyone has the potential. It's about unlocking it right. What's his approach?
He lays it all out in his book, One Up on Wall Street. It's like he's handing you a toolkit to demystify Wall Street.
I like it. Demystify Wall Street.
Oh,
Sounds
yeah.
like a plan. So what's in this toolkit of his?
It's all about understanding the businesses behind the stocks, not just chasing the latest trends. But before you even buy a single share, Lynch has this thing he calls a mirror test. 3 questions to ask yourself.
A mirror test. Okay. I'm intrigued. I like that he's making sure you're ready. Investing isn't just about money, right? It's about mindset, too.
Exactly. And his first question kind of throws you for a loop. Do I own a house?
Do I own a house? Okay. What does home ownership have to do with picking stocks? That's a curveball.
Right. At first, it seems totally unrelated.
Yeah, totally.
But Lynch sees homeownership as this crucial foundation. It's a stable, long-term investment. Often, he thinks it's a smart move before diving into the stock market roller coaster.
I see where he's going with that, building that solid foundation first.
Exactly. There's something grounding about knowing your housing payment is set versus the emotional ups and downs of stock prices every day.
Oh, absolutely. Riding the stock market wave can be intense, to say the least. Okay, so do I own a house? What's question number 2 in Lynch's mirror test?
Question 2 is, do I need the money?
Do I need the money? Okay, so this is about being honest about your financial situation.
Right.
Making sure you're not putting money at risk that you absolutely depend on.
Exactly. Lynch's core principle is only invest what you can afford to lose. It's about managing risk. Because if you need that cash for emergencies or have big financial goals riding on it.
You really don't want to be forced to sell at a loss if the market takes a dip.
Exactly. Sometimes it does feel like the market has a mind of its own. This question really highlights that you need to have your financial house in order before you start playing the stock market game. Emergency fund, clear goals, that's your safety net. All right, ready for Lynch's third question?
Hit me with it.
Do I have the personal qualities it takes to succeed?
Do I have the personal qualities? Now, that's an interesting one. I like that he's going there, because so much of investing is psychological.
Right. This one gets personal.
Totally. It's not just about the numbers. It's about temperament. Having the patience, thinking for yourself, being able to handle those market dips. That's what sets people up for success in the stock market.
It's almost like he's asking you to assess your own risk profile before you even look at a stocks. Can you handle the pressure?
All right, so we've had our little self-reflection session here thanks to Lynch. Now, let's get into the fun stuff. How does he actually find those winning companies?
This is where Lynch's contrarian approach really shines. He's not out there chasing the flashiest companies or the hottest tips.
Oh, really?
Mhm.
Interesting. So what's he drawn to?
He's drawn to the companies that Wall Street often overlooks, the ones that don't get a lot of hype.
Looking for diamonds in the rough. I like his style.
Exactly. And he even have a name for them. He calls them dull Normans companies with names that would make you yawn at a cocktail party.
Dull Normans, huh? All right, give me an example. I need a visual.
Think Crown, Cork, and Seal.
Crown, cork, and seal. I mean, that's pretty dull. What do they even do?
They make cans and bottle caps.
Cans and bottle caps.
Yeah.
Yeah, not exactly thrilling cocktail party conversation, but their stock performance.
Anything but dull. They've delivered steady growth for decades.
Wow, so much for judging a book by its cover, or in this case, a stock by its name.
That's Lynch's whole point. It's about looking beyond the hype and recognizing the value in those everyday businesses.
Yeah, like finding that incredible hole-in-the-wall restaurant that only the locals know about.
Exactly. And often, those boring companies, those dull Normans, they have something the flashy ones often lack. A solid track record, consistent earnings, strong cash flow. And those are the things that Lynch really loves to see.
Okay, I'm starting to see how tuning out the Wall Street hype machine can actually give you, the individual investor, an edge. So we've got the dull Normans. What other hidden gems is Peter Lynch looking for?
Another category that Lynch really likes is spin-offs. Have you heard of those?
Spin-offs, yeah, those are companies that get separated from a larger corporation. They're often overlooked because they're brand new and lack that long history that Wall Street loves to see.
Exactly, but Lynch sees that lack of attention as a potential opportunity.
Okay, so less history, more mystery. I'm listening.
It's like when AT&T broke up back in the day and all those baby bells were born.
Oh, yeah, I remember that.
Suddenly you have all these independent companies, often with really strong balance sheets and experienced management teams who are eager to prove themselves.
And that can lead to some impressive growth that a savvy investor can capitalize on, especially when Wall Street's sleeping on
It's like they've been waiting in the wings, ready to take center stage.
them.
All right, so we've got the Dull Normans, we've got the spin-offs. Now let's talk about the companies that actually do make headlines. The fast growers.
Fast growers, the ones with the exciting stories, tons of growth potential. Okay, those sound kind of sexy, but probably higher risk too, right?
Exactly. Investing in fast growers, it can be a wild ride. The potential is there for these incredible returns, but there's also the possibility of like a really rapid decline.
So how do you tell the difference?
Yeah.
How do you avoid those landmines?
It all boils down to understanding the company's story. Lynch uses the example of La Quinta Motor Inns back in the 70s. They were building motels, but they weren't just building any motels.
Oh, they found a niche, right? Like who are they targeting?
Yeah, instead of trying to be everything to everyone, they were very specifically targeting business travelers.
Ah, so they found their lane. And that focus, that niche, what did that do for their growth?
It fueled it. They were focused on affordable luxury specifically for that business traveler. It's a classic example of how a niche strategy can be a really powerful advantage.
Okay, so you've got to have a niche. I'm seeing a pattern here. It's not enough to just be in the game. You've got to be in the right game.
And Lynch is a big believer in that. He says that a strong niche provides this buffer against competition. He uses the example of Warren Buffett, how he's had so much success with businesses like newspapers and local TV stations.
Oh, I see, because they dominate their local markets. Like they're kind of untouchable.
Yeah, they become less susceptible to the winds of change because they've got that dominance.
Makes you think of like the Boston Globe back in the day, practically a monopoly on print advertising in the city.
Exactly. Talk about a powerful position to be in. So that's why understanding a company's niche is so important, because it tells you a lot about their potential for long-term success.
It's about their moat, what sets them apart, what protects them. Okay, this is good stuff. All right, so we've talked about those dull Normans, the spin-offs, and the fast growers. What about those companies that maybe have hit a rough patch but are trying to make a comeback? Lynch calls those turnarounds, right? Are those the hidden gems? They can be, but turnarounds are tricky. It's not enough to just see that a company is struggling. You've got to dig deeper and figure out why they're struggling. And are they actually capable of recovering?
Because you have to figure out if it's actually undervalued or just bad.
It takes a lot of digging to be able to separate the true comeback stories from those companies that are just, well, they're just headed for more trouble. You got to analyze what went wrong, how they're fixing it, and if the market is realistically pricing in their potential to recover.
Okay, so walk me through this. How do you spot a true turnaround story? Give me an example.
A classic turnaround story is Lockheed in the early 80s. Their commercial aviation division was bleeding money, especially that L-1011 TriStar passenger jet.
Oh yeah, the L-1011, not exactly a household name.
Right. Tough competition in that market. But then Lockheed, they make this gutsy move. They cut their losses, they phase out the L-1011, and they go all in on their more profitable defense business.
So they admit defeat in one area to focus on their strengths. Interesting.
And you know what? It worked. They take a big hit in 81, like a one-time loss, but then their earnings rebounded, stock price follows, and the rest is history. It just goes to show that short-term pain can sometimes lead to a long-term gain.
But only if the turnaround strategy is sound.
Exactly. It's a good reminder that even when a company seems like they're heading in the right direction, you've always got to keep your eye on those fundamentals, on the actual business, not just the stock price. Now, speaking of really understanding businesses, Lynch has this great term, diversification.
Diversification, that's
Wow.
not a real word, is it? What does that even mean?
It's not, but it should be. It's basically what happens when companies try to do too much. They overextend themselves, branching out into all these areas where they have absolutely no expertise.
Jack of all trades, master of none. Or in this case, jack of all trades, bankrupt by Tuesday.
Exactly. And Lynch gives some really good examples like Coca-Cola when they bought Columbia Pictures.
Drinks and movies, those two don't really seem to go together.
Yeah, not so much. Or Quaker Oats when they bought Snapple. Oatmeal and iced tea? What could possibly go wrong?
Apparently, a lot can go wrong. That seems like a classic case of corporate ego getting in the way of good business sense.
Often it is. Sometimes companies, even really successful ones, they just need to stick to their knitting, to what they know best.
Makes sense. And on a similar note, Lynch also warns against getting caught up in those whisper stocks.
Whisper stock. Oh, you mean those companies with those too good to be true stories? The supposed breakthroughs, rumors swirling.
Yes. It's so tempting to chase that allure of the inside scoop, to think you're in the know about the next big thing.
But like they say, if it sounds too good to be true,
It probably is. Lynch actually has this whole section in his book about whisper stocks that he lost money on. I mean, these companies had names like Worlds of Wonder and Pizza Time Theater.
Beats Time Theater. Serious.
Seriously, and it just highlights how dangerous it is to get caught up in that excitement, the story, without actually digging into the business. Because before you invest in any company, you've got to ask yourself, does this make sense? Is there a real sustainable market for what they're selling?
So skepticism is our friend.
Mhm.
Don't believe the hype. I feel like we keep coming back to that.
Right, like trust but verify. But once we've weeded out the hype, how do we actually evaluate the companies that do seem promising? We've identified those that pass the mirror test and don't set off any alarm bells. What then? What about the numbers?
The numbers, of course, we can't forget about those. Understanding a company's financials, I mean, that's key.
So where do we even start? What should we be looking at?
One of the most important things to look at, as you probably already know, is the price to earnings ratio. That's the PE ratio for short.
Right, that's the one that tells you how much investors are willing to pay for every dollar of the company's earnings. Right, so a higher PE ratio, that usually means there are higher expectations for future growth.
Exactly. But here's the catch. A high PE ratio, it can also mean that a stock is, well, overvalued, meaning the price has gotten a little ahead of itself.
Okay, so it's not always a good sign. That makes sense. Driven by hype, maybe, instead of the fundamentals.
You got it. Lynch actually gives this example. McDonald's back in '72.
McDonald's, okay. I'm picturing the Golden Arches, the Big Macs.
Great company, right?
Yeah.
But at that time, the stock price, it was so high that their PE ratio was 50, 50.
So even the best burger in the world can get overpriced on Wall Street.
You got it. It's about separating the company's actual performance from how its stock is performing, because those two things don't always line up perfectly.
They can get out of whack. So PE ratio, that's one thing to watch. What else is Lynch looking at when he checks out a company's financials?
Another big one for him is a company's cash position. He likes to see a nice, healthy pile of cash.
It's like having a financial cushion, right? Gives them more flexibility.
Exactly. That cash gives them options. Invest in growth, weather any storms that come along, even buy back shares if they want to, all of which are good things for us investors.
Those are all good things. So cash is king.
You could say that. One thing he specifically warns against is relying too much on book value, though.
Book value. Now remind me, that's the company's assets minus their liabilities, right? What's wrong with that?
I mean, it sounds good on paper,
Yeah.
right? But the thing is, book value, it can be misleading.
Yeah.
It doesn't always give you the full picture, like the true worth of a company's assets.
Okay, so there's more to it than meets the eye.
Exactly. It's not just about the numbers on the spreadsheet. It's about what those numbers represent. Like, take Penn Central. Their book value was over $60 a share when they went bankrupt.
Okay, I'm seeing your point. So book value doesn't tell the whole story.
Not even close. You need to really understand the quality of those assets, not just their stated value. And speaking of quality, another thing Lynch pays close attention to is a company's growth rate.
That makes sense, right? How quickly are they growing their earnings? Because at the end of the day, those earnings, they're the engine that drives the stock price.
Exactly. But here's the thing. Growth can come from different places. It doesn't always mean the business is expanding.
Oh, interesting. So how else can they grow if they're not just getting bigger?
Well, they can grow by doing things like cutting costs, raising their prices, even buying back their own shares.
Like tightening the ship, becoming more efficient. Doesn't have to be about just getting bigger.
Exactly. It's more about working smarter, not harder. And that's why when you're looking at a company's growth rate, it's important to understand how they're achieving that growth.
Makes their growth rate even more impressive if they're doing it by becoming more efficient. Now, I want to go back to something you mentioned earlier. This idea that we shouldn't be trying to time the market.
Ah, yes, the art of market timing. It's tempting to try to predict those ups and downs, but in my experience, it's a fool's errand. And Lynch would definitely agree.
Because nobody has a crystal ball, right? Despite what some financial gurus might try to tell
They
you.
might as well be reading tea leaves. You can't control the market, but you can control your own actions. Focus on finding great companies, buying those stocks, and then holding on to them. Let that compounding do its magic over time.
It's about playing the long game. And speaking of long-term strategies, I'm curious about Lynch's philosophy on diversification.
He has a really interesting take on diversification. He's definitely not opposed to it, but he's also not about spreading yourself way too thin, putting a tiny bit in everything.
So it's not just about having a certain number of stocks, it's more nuanced than that.
Right. Lynch believes it's better to concentrate your investments in a smaller number of companies that you truly understand deeply.
So it's that saying, put all your eggs in one basket and then watch that basket very closely.
Yeah, something like that. But in all seriousness, if you've done your research and you really believe in a company, then don't be afraid to make it a more significant part of your portfolio. Now, on the flip side of that coin is knowing when to sell a stock, which is just as important as when to buy.
We talked about those sell signals earlier. What are some of the red flags that investors should be looking out for? When is it time to say goodbye to a stock?
Well, a big red flag is when the company's story changes. For the worse, obviously.
Yeah.
So if you start to see earnings declining or maybe debt starts piling up or if management starts making some questionable moves, well, then it might be time to rethink things.
It's like going back to your favorite restaurant and realizing the food's not as good, the service is terrible, and they've jacked up the prices.
It just might be time to find a new favorite. You're not obligated to stick with something that's not working.
Loyalty is great, but not when it comes to your portfolio.
Right. Another reason Lynch might sell a stock is if it becomes way overvalued. Like if that stock price is getting way ahead of the company's fundamentals, well, it might be time to ring the register and take some profits off the table.
That takes discipline, especially when a stock's on a hot streak. It's hard to resist that fear of missing out.
Oh, absolutely. FOMO is a powerful force. And you might even leave some money on the table. But, remember, you're not marrying these stocks. Sometimes you just have to move on.
So no need to feel guilty about breaking up with a stock when it's time.
Exactly. Although, on the other hand, you also don't want to jump ship too soon. A lot of investors, they make that mistake, selling their winners too early.
Because they're afraid of those gains disappearing, they want to lock them in.
Totally. And look, it's certainly tempting to take your profits when a stock's on a roll, but Lynch emphasizes that the biggest returns, those often come from letting your winners run.
So find a good company and then just hold on tight.
Pretty much. He held on to stocks like Subaru, Stop and Shop, La Quinta. He held on to those for years, and just watched them multiply in value.
Wow, that's incredible. Patience really is key. It's like that baseball analogy. If you're winning by a few runs in the early innings, you don't pull your star player. You let them keep playing and hopefully they keep hitting home runs.
Exactly. You've got to give those companies a chance to keep hitting home runs.
Yeah.
If you've got a winner, don't be so quick to sell just because you've made some money. Give those companies a chance to keep growing and creating more value, and you might be surprised how high that stock price can go.
That's a good problem to have. But all this talk about winners and losers, it really highlights something else about investing. You've got to learn to manage your emotions because let's be real, the stock market can be an emotional roller coaster.
Oh, tell me about it. 1 minute you're riding high, you're on top of the world, and the next minute you feel like you're plummeting back to earth.
Right. It can feel like everyone has a hot stock tip or some doom and gloom prediction, and it's hard to know who or what to believe. So how do you stay calm, cool, and collected when it feels like everyone is losing their minds?
This is where Lynch's emphasis on discipline is so important. Don't get swept up in that daily news cycle. Don't listen to all the noise and the hype. And definitely don't try to predict every little twist and turn in the market, because that's a recipe for disaster. Focus on the fundamentals we keep talking about and remember that it's a long game.
Way easier said than done, though, right? I mean, it's your money on the line.
Oh, for sure. It
Yeah.
definitely takes practice. But one thing Lynch recommends is having a clear investment plan. Actually write it down and make sure you're reviewing it regularly.
So you don't get caught making rash decisions based on emotions.
Exactly. Having that plan, it can really help you stay grounded when those emotional waves hit, especially when you're feeling the FOMO, the fear of missing out.
Ugh, the dreaded FOMO. It's everywhere these days, especially with social media. Everyone's making a quick buck, or so it seems. It's hard to resist that pull.
Oh, it's everywhere.
Yeah.
It's easy to fall into the trap of chasing those hot stocks, thinking they're the next big thing. But Lynch warns against that.
Because those hot stocks often cool down pretty quickly.
Exactly. You know what they say, don't try to catch a falling knife? You're more likely to get hurt. Patience is key. Let that initial excitement die down. See if the company's plan is actually panning out. If there's any substance behind all the hype. It's about being thoughtful and deliberate, not reactive.
Not letting your emotions make decisions for you. Now, speaking of making decisions, Lynch actually thinks individual investors have a surprising advantage over those big Wall Street pros. How is that even possible? They're the
I
professionals.
know it seems counterintuitive, right?
Yeah.
But his reasoning makes a lot of sense. You see, those big institutions, they're often so focused on the short term, chasing those quarterly earnings reports, the latest trends, they need to show quick results.
They have people to answer to, right?
Right. Individual investors, on the other hand, they have the luxury of taking that longer view.
It's true. We're not answering to impatient clients or trying to justify those hefty management fees.
Exactly. And that kind of freedom, that can be a huge advantage. It allows you to focus on those under-the-radar companies, the ones with the rock-solid fundamentals that Wall Street might find, well, kind of boring.
Too busy chasing the next shiny object.
Exactly. But those boring companies, they often have what it takes to be steady, long-term winners.
Mm.
It all goes back to tuning out the Wall Street hype machine.
Sticking to your knitting,
Yeah,
focusing on what you understand, and doing your research.
couldn't have said it better myself.
Well, I think that's a great place to wrap up our deep dive into Peter Lynch's One Up on Wall Street. We covered a lot of ground.
We really did.
Yeah.
We talked about how important it is to truly understand those businesses behind the stocks, that you can't just focus on those stock prices in isolation.
We talked about those key company categories that Lynch looks for, the dull Normans, the spin-offs, the fast growers, and those turnarounds, and those companies he avoids, like the plague, those diversified companies and whisper stocks. And we even got a little philosophical, talking about the psychology of investing.
Oh, for sure. It's not all about spreadsheets and numbers, is it? There's a human element to it.
It's about discipline and patience. It's about self-awareness, and it's about really knowing yourself as an investor.
Yes, remember that mirror test we talked about? That's really just the beginning. Understanding your risk tolerance, your temperament, what you're comfortable with, it all plays a part in shaping a winning strategy.
And remember, there's no one right way to invest. What works for one person might not work for another. It's about finding your own style, your own groove.
It's about playing to your strengths. And I can add one more thing. Don't be afraid to learn from your mistakes. Everybody makes them.
Even Peter Lynch, he talks pretty openly about his own investing blunders, right?
He does. And he sees those mistakes as learning experiences.
So what's the big takeaway? What's the one thing we should remember from all of this?
You don't need a fancy degree or to work on Wall Street to be a successful investor. Anyone can do it.
Invest in what you know. Do your homework. Be patient. Stay disciplined. Ignore the hype. Great advice.
It's all about common sense, good research, and having a long-term perspective. And maybe, just maybe, if you follow those principles, well, you could be the next Peter Lynch.
That's what I like to hear.
Yep.
Until next time, happy investing, everyone.